Title: The Economic Conductor: The Impact of Federal Reserve Monetary Policy on Investments. Introduction. In the intricate dance of financial markets, the Federal Reserve emerges as the maestro, wielding its monetary policy as a baton to orchestrate the movements of interest rates, money supply, and economic growth. Investors keenly watch this central banking institution, understanding that its policy decisions reverberate through the entire investment landscape. To unravel the complex web of interactions, it is essential to explore how the Federal Reserve's monetary policy becomes a pivotal force shaping investment decisions. Monetary policy tools. The Federal Reserve employs an array of tools to execute its monetary policy, with the primary objectives of fostering maximum employment, stabilizing prices, and supporting long-term interest rates. These tools include open market operations, the discount rate, and reserve requirements. Through these mechanisms, the Fed seeks to influence the overall economic climate, which in turn has profound implications for investors across various asset classes. Interest rates as the pivot point. At the heart of the Federal Reserve's monetary policy lies the manipulation of interest rates. The central bank utilizes its authority to set the federal funds rate, the interest rate at which banks lend to each other overnight. This benchmark rate, in turn, influences a myriad of interest rates throughout the economy, from mortgages to corporate bonds. When the Federal Reserve adjusts interest rates, it sends ripples through the investment landscape. A rate hike is a signal of confidence in the economy, aimed at preventing overheating and inflation. Higher interest rates can impact investment decisions by increasing the cost of borrowing, affecting the profitability of businesses and influencing consumer spending. As a result, investors recalibrate their portfolios in response to the evolving interest rate environment. Conversely, during economic downturns, the Federal Reserve may lower interest rates to stimulate borrowing and spending. This accommodative stance is designed to encourage investment and spur economic growth. Lower interest rates can lead investors to seek higher returns in riskier assets, such as equities, as fixed-income investments may offer diminished yields. Thus, the ebb and flow of interest rates serve as a crucial determinant of investment strategy. Quantitative easing and asset prices. In addition to manipulating interest rates, the Federal Reserve employs unconventional measures such as quantitative easing, QE, to influence investments. During periods of economic distress, the central bank may embark on large-scale asset purchases, injecting liquidity into financial markets. This infusion of capital has a direct impact on asset prices, affecting everything from stocks to bonds and real estate. Consider the aftermath of the 2008 financial crisis when the Federal Reserve engaged in successive rounds of QE. The influx of liquidity into the markets led to a surge in asset prices, with equities experiencing a bull market and real estate values rebounding. Investors, attuned to the central bank's actions, strategically positioned their portfolios to capitalize on the QE-driven rally, underscoring the profound influence of monetary policy on asset values. Inflation expectations in the TIPS market. The Federal Reserve's dual mandate includes maintaining price stability, with a target inflation rate of 2%. As such, investors closely monitor inflation expectations, as deviations from the target can impact the real returns on investments. The Treasury Inflation-Protected Securities (TIPS) market becomes a barometer of these expectations, providing insights into how investors perceive inflation risks. The Federal Reserve, perceived as falling behind the inflation curve, might prompt investors to allocate their portfolios to assets that historically act as hedges against inflation, such as commodities or inflation-protected securities. Conversely, a proactive stance by the central bank to control inflation can influence investment decisions by shaping expectations about future purchasing power and the attractiveness of different asset classes. Forward guidance and investor expectations. The Federal Reserve doesn't merely influence investments through direct policy actions, its communication strategy also plays a pivotal role. Through forward guidance, the central bank provides insights into its future policy intentions, helping shape investor expectations. The clarity or ambiguity in the Fed's messaging can lead to market volatility as investors adjust their strategies based on their interpretation of the central bank's stance. For instance, if the Federal Reserve signals a prolonged period of low interest rates, investors may adjust their portfolios to capture yield in riskier assets. On the contrary, hints of an imminent rate hike may prompt a shift towards more conservative investments. The nuanced language of the Federal Reserve's communication becomes a key consideration for investors crafting their investment thesis. Global impact and capital flows. The Federal Reserve's monetary policy doesn't operate in isolation, its decisions have a ripple effect globally. Changes in U.S. interest rates can attract or repel foreign capital, influencing exchange rates and impacting investments in international markets. A rising interest rate environment in the U.S. may lead to a stronger dollar, affecting the competitiveness of U.S. exports and influencing multinational companies' earnings. Consider the scenario where the Federal Reserve embarks on a tightening cycle while other major central banks maintain accommodative policies. Investors might reallocate their portfolios to take advantage of higher yields in the U.S., leading to capital outflows from other regions. This dynamic interplay underscores the interconnectedness of global financial markets and the far-reaching impact of the Federal Reserve's decisions on investment landscapes worldwide. Conclusion. In the grand theater of finance, the Federal Reserve assumes the role of a central player, shaping the investment narrative through its intricate monetary policy maneuvers. Investors, in turn, must act as astute observers, deciphering the signals embedded in interest rate movements, asset purchases, and forward guidance. The interplay between monetary policy and investments is a complex ballet. And those who can adeptly interpret its choreography position themselves to navigate the ever-changing currents of the financial markets with acumen and resilience.